Technofunk, the institute enabling information technology professionals gain functional, domain and leadership expertise. Presents next tutorial on functional knowledge. This tutorial covers the overview of accounts payable and helps you learn the concept of accounts payable process and its role in any automated accounting package. Stay tuned to learn the key functional areas of accounts payable. Accounts payable definition. Accounts payable is the amount owed for the purchase of goods or services at a specific date. It is the money that a company owes to vendors for products and services purchased on credit extended in the normal course of business. As a general practice, suppliers offer to their customers credit, which is an payment arrangement to pay for a product or service after it has already been received. Accounts payable is presented as current liabilities under the liability section of the balance sheet. It represents a negative cash flow for the company. Accounts payable are often referred to as payables. Accounts payable is considered as current liability, meaning that it is a short-term credit extended to the business expected to be fulfilled in less than a year. How do we define accounts payables? We all use utilities. For example, we take various services from the phone company, the gas company and the cable company. They provide us the goods and services first, and at the end of the agreed billing period they raise an invoice on the customer. In this case, the utility company is our creditor and they have provided us the service on credit. The amount payable to the utility company is the account payable for us, which needs to be paid in very short term to the utility company, supplier/creditor, to enjoy continued services. Similarly, credit is extended in the normal course of business to the customers on the purchase of goods and services and needs to be paid off within a given period of time in order to avoid default. Payables are often categorized as trade payables and expense payables. Trade payables are the monies due for the purchase of physical goods that are recorded in inventory. Expense payables are the monies due for the purchase of goods or services that are expensed. Common examples of expense payables are utilities like telephone and electricity. Accounts payable description. Accounts payable is used as a generic term to represent various different things related to a process. Some of the common usage of the term is accounting entry. As explained before, accounts payable refers to the accounting entry that indicates a short-term liability payable to the supplier of goods and services for the goods supplied or services rendered. It is a short-term liability and categorized as current liabilities under the balance sheet head liabilities. Accounts payable subledger. Companies and businesses have huge transactions pertaining to their accounts payable process. They receive goods and services from various suppliers and they need to manage timely payments to these creditors to avoid default and adhere to the payment terms. They use a subsidiary ledger generally referred to as accounts payable subledger and sometimes just as accounts payable. Accounts payable process. Accounts payable term is also used to refer to the accounts payable process. This process involves receiving the goods or services, verifying the quantity and quality with the supplier invoice and releasing the payment as per the agreed payment terms. Accounts payables department. As companies have large number of transactions related to a process, hence many a times they need a separate division, branch or department to manage and handle all the app-related transactions. That department is referred to as accounts payable department and sometimes just as accounts payables. Eventually, once we understand the accounts payable process and what are its elements, we can easily understand what is being referred to at any point in time. Accounts payable journal entry. As discussed earlier, accounts payable refers to the accounting entry that indicates a short-term liability payable to the supplier of goods and services for the goods supplied or services rendered. Although in the large organizations the procure-to-pay accounting process starts when the purchase order for supply of goods is released to the supplier. To keep things simple in the beginning, we will discuss the core accounting entries related to the accounts payables process. Receipt of goods. You issue purchase order to the supplier and he supplies you with the goods. Once the ownership of the goods gets transferred from the supplier to us, we account for the goods as our inventory and based on the invoice received from the supplier need to create a liability for the payment due to him. At this stage the accounting entry is debit inventory account, credit accounts payable account, making payment to the supplier. Once the payment for the invoice is released, then funds gets released from the bank or cash and the amount due to the supplier gets knocked off. For this part the accounting entry is debit accounts payable account, credit cash/bank account. Subsidiary ledgers. The app ledger. Imagine what the size of your general ledger would be if you have 8,000 different suppliers sending you more than 2,000 items that you trade in. Subsidiary ledgers help manage and store specific information regarding each of the control accounts in your GL. And subledger for app is called app subsidiary ledger. The purpose of accounts payable subledger is to manage the suppliers and the payments related to purchases. An accounts payable invoice gets recorded in the account payable subledger at the time an invoice is received and validated that the respective goods corresponding to the invoice have been received. Then it is verified and vouchered for payment as per the payment terms agreed with the supplier. Account payable process 1. Issue purchase order. The app process starts with the issue of purchase order to the supplier. The purchase order specifies what you intend to buy, the make and the quality of the goods. In some cases it also specifies the agreed quantity and the price. 2. Receive goods. Based on the purchase order the supplier will ship the product. Till goods have been received by the customer, the ownership generally lies with the supplier. Once the goods are received at your godown, you become the owner of the goods. 3. Inspect goods. Most organizations have the internal control processes to inspect the goods to ensure the quantity and quality of the supplied material. 4. Enter invoice. Supplier issues and credit invoice, and collects payment later. This describes a cash conversion cycle, a period of time during which the supplier has already paid for raw materials but hasn't been paid in return by the final customer. Received invoice is accounted for in the books of the customer. 5. PO match and receipt match. When the invoice is received by the purchaser it is matched to the packing slip and purchase order. And if all is in order, the invoice is paid. This is referred to as the three-way match. The three-way match can slow down the payment process, so three-way matching may be limited solely to large value invoices, or the matching is automatically approved if the received quantity is within a certain percentage of the amount authorized in the purchase order. 6. Release and make payment. Once the matching is done and accounts payable department is satisfied to the accuracy and validity of purchase, they refer to the payment's terms. Companies may have negotiated different payment terms with different suppliers. Payment is released based on the agreed payment terms and amount is issued to the supplier. 7. Bank reconciliation. Generally the payment is made through the bank. There is a slight delay between the date when the payment is released and when it reaches to the account of the supplier. The bank entry is reconciled to the original payment entry in the payments register to reconcile the both accounts, and this completes the account payable process. In the next video tutorial we will take you through the accounting entries in the payable process. Large companies have huge number of suppliers. To remain competitive they need to manage their procure-to-pay process very effectively. They create specialized division to handle these operations. The business department that is responsible for making payments owed by the company to suppliers and other creditors is also often referred to as Account Payable, AP. Thank you for watching/downloading our training material. Users are free to download the material for their personal use only. Commercial use is strictly prohibited without prior permission from the Charter Techno-Functional Institute. If you need copies of this material for corporate training or commercial use, please contact info@technofunk.com for further details.